Hello, I'm Jim Elios. Welcome to our discussion on financial planning, retirement planning, taxes, and investments. We're going to have some fun with this. Please stay tuned and look for more details at eliosfinancial.com. Over the years, I've come up with some concepts about money, and this one I think is one of the most important things. And I always say that successful investing long-term is directly related to one thing: your behavior. And what do I mean by that? Many books have been written about the science of behavioral finance. And basically, behavioral finance says that, hey, we're human beings. We don't make decisions in a scientific manner. It's really blending the psychology of money is really what it is. One of the most important roles of a good financial advisor is navigating clients' emotions. A good financial advisor can help you navigate all the volatility in the market, all the emotional ups and downs of investing in the market. When the market's going up, people are really excited. People want to buy more naturally, and they're buying at the worst time at the top of the market. Conversely, people get very scared or concerned when markets are going down, and they want to sell. The exact opposite of what you should do. And often that is, again, one of the most important things that a good advisor will do is get the emotions out of it, have a plan, and give really good counsel and advice. A really interesting part of behavioral finance is something called recency bias. And we're all victims of having some recency bias. And let me give you an example in a sports environment here. So you might ask a basketball fan, who's the greatest basketball player of all time? And some people will say, of course, it's Michael Jordan. And then people will say, no, it's LeBron James. LeBron is still playing. And a lot of people remember him here in the last 5, 10, 20 years. What a great career. What an incredible athlete, incredible sports. But people forgot how dominating Michael Jordan was. But that was 30, 40 years ago. So we might think, hey, LeBron is better just because he's still playing, and that's the recency part of that. So an example of recency bias is the technology stocks. The last 10 years, tech stocks have done fantastic with big tech companies, double-digit returns for a long period of time. So we have a bias towards technology stocks. But who could forget the tech wreck of 2000 and 2002 when anything technology, anything that had .com in the early internet era was terrible. And so a lot of people were scarred from buying technology stocks for a long period of time 2 decades ago. I have found that recency bias really can impair a good investment plan. A good advisor will help you navigate behavioral finance and avoiding the pitfalls of being overly emotional and having bias towards certain things. Look for more details at eliosfinancial.com.